Hi, I'm Jim Cramer, Portfolio Manager for Action Alerts with our Research Director, Jack. We're trying to make some sense of the turmoil. I want to follow up on pretty much all the bearishness that we have been commenting on since the Fed raised rates, and then continue on what we said last week in our seminar that we have for people, which is that the sentiment, while very negative, may not be enough to be able to turn the market around. And what we're trying to do is, with the biggest cash position we've had in years, is say, listen, when we think that it can be valuable, we will put some money to work, but that cash position is really pretty sacred because the market's so bad. But we are beginning to see levels that we think are attractive versus where we sold some stocks.
Exactly, and I think that's where, it's so important to look at where we sold stocks, but it's also so important not to fight the market, but at the same time, recognizing which trends in the long term are going to be destructive to certain companies, which is international exposure, the FX headwinds that we were speaking about this morning in our huddle up. And the impact that will have on companies, I think, is going to be larger than many people realize.
Right. I think that if people are in our huddle up, and we obviously talk every morning, we email back millions of times, what we're saying is that IBM reports a number, and they say, okay, look, this is what our number would have been if the dollar weren't so strong. And what this quarter has marked is that nobody cares anymore. We're not looking at the constant currency versus the currency. We're just saying, okay, listen, it's a fact of life that the dollar's going to stay strong. It may get even stronger. So rather than adjust IBM's $13.50 earnings to 15, if you add back tax but basically if you add back currency, $1.2 billion currency hit, you could say it's $14.50. We're not looking at $14.50, 15 anymore. We're just saying, okay, $13.50 it is. And because you're cutting the estimates of a company, then we pay a multiple point less, typically, maybe even 2 more points. So you can figure out how IBM got to where it is, which is 9 times 13, give or take 10 points. And this is a very big theme for earnings for international companies, which is that we're no longer going to forgive them if they have a different number from currencies.
Right, and that's why we're looking at the AEPs, American Electric
And why we have to sell, unfortunately, 3M, which
right,
is such a good
3M,
company.
which is a good company, and there is a comeback story there, but they haven't proven themselves yet. And to be honest, the FX headwinds, we can't even quantify, it's going to be a drag. So we're sticking with domestic, we're sticking with proven stories, we're sticking with value, but within the context of stability. And I think we have some in Jack in the Box, we have some in Panera, we have some
These are raw costs all going down, business doing better. Panera, obviously, and Jack in the Box really benefiting from what is a remarkable decline in Chipotle. But I'll tell you, here's, because we play with an open hand. I mean, for instance, Target, we sold some higher. It was a really good sale. I would like to get back in and buy some more, but the problem, and it's got a good yield. Problem is that they fired their person who runs domestic, and we're seeing all of these stocks go down, so why not wait? And so people could say, well, wait a second, you sold stock to 73, you really like Target. We do like Target, but what we're trying to do is make a difference in our basis when we buy something. One of the things I've learned as a portfolio manager, and obviously this is a portfolio manager product, is don't buy more stock at the same level. Target, if we bought it in the high 60s and it's back to the high 60s, don't wait. I don't buy it in the high 60s. Buy it when it gets to 63, 64. Well, what happens if it gets to it doesn't go down anymore? Well, that's fine. We still have a position. But this is the discipline that we're trying to teach with this product.
We have been tempted so many times since the start of this year, and even in the end of last year, to start diving into the market, and we haven't. And I think just trying to exercise patience and discipline is so crucial. There will be opportunities. We will be buying when we see the value, when we see the stability, and the visibility. But until then, you can't fight the market.
Right. And now we've had to make some sales that I don't like. I mean, we had to sell, we had to sell EOG, which is a great company, but then it immediately goes down 10%.
Yeah.
Had to sell some Oxy because the people don't believe the dividend protection. Oxy's probably the finest, other than Exxon and Chevron, which actually is in many ways more optionality of what they can do. But it doesn't matter. And what I'm urging people to do is stay close to our bulletins. We've been doing these really incredible, I think, bulletins every day, which are kind of like what a portfolio manager dreams of. And Jack works just tirelessly on these bulletins. We go over and over and over again. Please read them because they buttress the kind of bearishness that we've been trying to get you to understand. I just feel terrible. People are losing money. We're losing money, but we're losing less money. Sometimes that's better, and then when times are better, we hope to make more money. We have a charitable trust. We're not a hedge fund. But there's obvious places where you can't be, and there are obvious places where you can be, and we're trying to be in the best places possible.
And you'll know exactly what we're thinking when we're thinking it, and that is so important.
All right. Thank you, Jim.
Thanks, Jim.